Welcome back to Investing Talk podcast.
Today we're looking at ACHR Aviation. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, ACHR Aviation. We're talking like the absolute cutting edge here, aren't we? Electric vertical takeoff and landing eVTOL.
Exactly. It's positioned right at the heart of what they're calling urban air mobility, or UAM.
The whole idea is getting off the ground, literally, avoiding traffic.
That's the big picture, yeah. That's the structural growth story the market seems to be buying into. ACHR's focus is really clear. Direct-to-consumer aerial ride-sharing.
Like air taxis.
Pretty much. And think about it. Cities get denser, traffic gets worse.
Yeah.
Suddenly flying over doesn't seem so sci-fi, more like a necessity, that potential. That's where the heat around this stock comes from.
And you can see that heat in the analyst ratings. Our sources are showing a really strong consensus, a strong buy. And those 12-month price targets are pretty tightly grouped, right? Around $13.14 to $13.43.
Yeah, that kind of alignment often signals real confidence, not just in the general idea, but in ACHR's, specific plan to get there.
Right. But confidence is one thing. We need to look at the numbers, the fundamentals.
And that's where it gets interesting, because this isn't some established company. It's very much early stage, high growth potential, but also, deep in that investment phase.
So what jumps out from the financials? What would make let's say, a traditional value investor a bit nervous?
Well, the big one, the unavoidable thing, is zero reported revenue right now.
Which is normal for this kind of venture, deep in R&D.
Totally normal. But what's maybe less typical is just the sheer scale of the spending. The net loss reported was $612.80 million.
Wow, $600 million. That's a huge cash burn.
It is. It's enormous.
So how do we square that? I mean, for a listener thinking about profitable companies, that sounds like a red flag.
You square it by looking at the market cap. It's still $7.28 billion. That tells you the market isn't looking at last quarter's sales because there weren't any.
Right.
It's valuing the future, the potential revenue streams, the regulatory milestones they might hit. That $612 million loss. The market's treating it like an investment, basically. A bet on the future.
Okay, but that bet hinges entirely on how long their cash lasts, doesn't it? The runway.
Absolutely critical. If you're seriously considering this, you have to dig into those SEC filings. Don't just glance at the cash reserve.
You need the burn rate.
Exactly. Calculate the fuse length. Right now, the market seems okay, maybe thinking they've got, 18 months or so at this rate. But if that upcoming Q3 earnings report in November shows the burn rate accelerating, say suddenly it looks like they only have 12 months left, that $7 billion valuation could take a serious hit fast.
So cash runway is priority number one for due diligence.
It's the lifeblood and the number one financial risk, really.
Okay, that makes sense. So shifting from the burn rate, what are they doing to defend their position while they have that cash? Building competitive advantages. It's not just about having a cool plane design, I assume.
No, definitely not. It's about building that technological moat. They're focusing on their unique tech, building brand recognition. But the really interesting move lately was beefing up their IP portfolio.
Ah, yes, the patent acquisition from Lilium.
Right. 300 patent assets, cost them about $18 million. That's not just buying tech. It's kind of neutralizing a competitor's potential leverage down the line while strengthening their own position. It felt pretty aggressive.
Yeah, a smart defensive and offensive play.
Yeah.
Signals they want to dominate.
It's a key investment, and you can almost see the market rewarding moves like that on the charts.
Okay, let's talk technicals then. What are the charts telling us recently, especially around momentum?
Well, volatility is high, no surprise there. But the underlying trend looks generally positive. The stock's been bouncing between roughly $11.12 and $13.65. What's technically significant is it's been trading consistently above both the 50-day and the 200-day moving averages.
Which is a classic bullish signal, right? Short-term strength outpacing the longer-term trend suggests momentum.
Precisely. And then you look at something like the RSI, the Relative Strength Index.
Checking if it's overbought.
Yeah. And it's actually very neutral right now, around 46.56. That's good news, actually. After a run-up, you don't want it screaming overbought above 70 because that usually means a pullback is coming.
So neutral RSI means it potentially has more room to climb.
Potentially, yeah. Room to run without being technically stretched. Now, that volatility number, 12.83% over the last month, that's significant.
A high-risk, high-reward territory.
Definitely. And that volatility is clearly tied to all this news, especially the big global deals they've been announcing one after another. Investors should keep an eye on that resistance level just over $14.
A break above $14 would be a big technical win.
Huge. Could signal the start of a more sustained move higher.
And you mentioned those global deals driving things. Let's unpack those. They seem pretty foundational.
They really are. Archer isn't just thinking about, flying around California. They're making concrete moves to be a global player. These aren't just MOUs. They feel like transformative partnerships.
Okay, walk us through them. There was Japan first, right?
Yeah, back in August 2025, they partnered with Soracle, that's a joint venture, Japan Airlines, and Sumitomo Corporation for services in Osaka.
Why Osaka?
Density. It's one of the most packed urban areas globally. The thinking is, if the tech and the model work there, it's a massive proof point. It can work almost anywhere.
Okay, density proven. Then the Middle East deal seemed different.
It was. September 2025, partnering with Cleveland Clinic Abu Dhabi. This wasn't about tourism. It was about developing the first hospital-based vertiport in the region.
So medical applications, emergency transport?
Exactly. It shows the versatility beyond just standard air taxis, opens up potentially lucrative niche markets down the road.
Right. And then the biggest one, the one that really moved the stock, Korea.
That was the showstopper, yeah. October 2025, Korean Air. Considering buying up to 100 of Archer's Midnight aircraft.
100 aircraft from a major airline like Korean Air.
Yeah, think about the validation that provides.
Yeah.
Huge signal of trust in the tech and the company. The stock jumped nearly 4% just on that news, October 24th.
So summing up the global push, Japan for density, Middle East for specialized use cases, Korea for large-scale airline adoption, it really does look like they're ticking all the boxes.
It positions them as a genuine global first mover, validating the tech for different real-world urban environments.
Okay, so the strategy looks solid on paper, and now it's about execution.
Always. Which brings us neatly to the catalysts. What should investors be watching for?
Let's start short term, 0 to 3 months out. What's immediately on the horizon?
Biggest thing is the Q3 earnings report, expected in November. Everyone will be scrutinizing that. Not just for the financials, but crucially for updates on production progress for the Midnight aircraft.
And that cash burn rate we talked about.
Definitely. They need to show they're managing it and, ideally, making tangible progress on building planes. Then, in December, something less exciting but potentially impactful. The Russell Index rebalancing.
How does that work?
Well, if Archer gets included, or its weighting increases in key Russell indices, index tracking ETFs have to buy the stock. It creates automatic buying pressure, passive investment flow, regardless of news.
Interesting. So institutional mechanics.
Yeah. And underlying all of this, always, is the ongoing push for regulatory approvals, especially from the FAA. That's the constant overarching catalyst for the whole sector.
Right. What about longer term, beyond the next few months?
Looking further out, say January 2026, we'd expect some kind of year-end production update. That'll be a major check-in on their manufacturing scale-up. Can they actually ramp up from prototypes to commercial volume?
And following up on that big Korean Air deal.
Absolutely. By February 2026, the market will want to hear about progress on executing that partnership. Are they on track to potentially deliver those aircraft?
Okay. And then there's always the rumor mill with these kinds of stocks, isn't there? The speculative stuff.
Oh, definitely. Lots of buzz, persistent talk about maybe getting FAA-type certification earlier than expected for the Midnight aircraft. That would be huge, obviously.
What else? More partnerships.
Rumors keep swirling about more big deals in Asia, maybe targeting China or Southeast Asia. Makes sense, given the urban density there.
I've also heard whispers about bigger strategic investors.
Yeah, speculation about a major automotive company potentially stepping in with an investment or joint venture, bringing manufacturing expertise. That's a common theme. And, always some chatter about potential military or government contracts.
But we have to stress those last few are just rumors at this point.
Absolutely. Pure speculation. But it definitely adds to the excitement and the volatility around the stock.
Which is a good segue into the risks. We can't ignore the potential downsides here.
No. Definitely not. The potential reward is high, but so is the risk. Management seems capable. They've navigated partnerships, IP deals well, but the company-specific risks are substantial.
Like the technology itself.
Well, not just the design, but scaling the manufacturing. Building a few prototypes is one thing. Mass producing them reliably, safely, cost-effectively, that's a whole different challenge. Any hiccups there could cause major delays.
And the biggest hurdle of all regulation.
The FAA. It's the ultimate bottleneck, isn't it? They're charting new territory here. It's not like certifying a standard airplane. The pathway is complex, maybe combining parts of different existing regulations.
So any delay from the FAA.
Even just a change in testing requirements could push back commercial launch by quarters, maybe even years. And given that cash burn rate we discussed, delays could be fatal.
And they're not operating in a vacuum. Competition.
Right. Joby Aviation is probably their closest rival in the U.S. Very similar ambitions. Internationally, Lilium is still a major player, even after selling those patents. They have a different design, maybe a longer range potential.
So it's a race.
It's absolutely a race. Who gets full certification first? Who scales manufacturing fastest? That likely determines who grabs the crucial early market share. If a competitor beats Archer to market in key regions, that first mover advantage evaporates.
Okay, so summarizing the risks. High cash burn means timelines are critical. Execution on manufacturing and regulation has to be near perfect, and they need to stay ahead of well-funded competitors.
That's it in a nutshell. So when you put everything together, the strong analyst backing, the ambitious price targets, the global strategic positioning, the bullish technicals, but weigh that against the very real execution and regulatory risks.
Where do you land? What's the overall take?
We land on an overall bullish rating, but with caveats. Let's call it an 8 out of 10.
An 8 out of 10. So back to the original question. Is it a buy now?
It looks attractive, potentially, for both types of investors. Short-term traders might play the catalysts, earnings, production news. Long-term investors are buying into that massive structural shift towards urban air mobility.
But it's clearly not for the faint of heart.
Absolutely not. This is high risk, high reward. You have to understand the potential pitfalls.
A balanced view on a company built entirely on the future.
I think so. And maybe the final thought for listeners to mull over is this. Given how much hinges on these partnerships and hitting production targets, the key question isn't just if they can get FAA approval eventually, it's can they scale up fast enough to actually capitalize on it and hold off competitors. That speed of scaling, that's probably what will separate the winners from the also-rans in this space.